I'm excited to have the opportunity to talk to you about my latest book, Trading Commodity Options with Creativity. In this book, we talk about when, why, and how to develop option strategies to improve the odds of success in any market environment and risk reward profile. In other words, we're looking to customize Delta based on a trader's risk and reward profile, their personality, their account size, etc. Some of you might be aware that in 2008, I published my first book on commodities. It was titled Commodity Options. The publisher was FT Press. At the time, I'd been in the business for 4 years, and at that age, when you're young and dumb, you think 4 years seems like an eternity. In my greenness, I believed that I had seen and experienced it all, and therefore, nothing could ever top what I created in 2008 with commodity options. And boy, was I wrong. I'm honored to have received feedback from some of my friends and colleagues in the industry. If you're interested in learning what some of the others have to say about this book, you'll find peer reviews at www.tradingcommodityoptions.com. If you're not familiar with who I am and what I do, my name is Carley Garner. I am a futures and options broker. You can find me at decarleytrading.com. You'll also find a plethora of educational material, videos, articles, all kinds of good stuff, regardless of the strategy you're looking to trade or the approach to commodities you're looking to make. We try to keep everything as realistic as possible. We're not sugarcoating anything. The reality is trading is very difficult. We're attempting to beat the markets, and that's not easy to do. So we'll give you the skinny, the good, bad, and the ugly at decarleytrading.com. You can also find us on social media, Facebook, Twitter, Instagram, and of course, YouTube. I do write a column for Stocks and Commodities magazine. It's a monthly column. It's called Futures for You. I contribute content to Jim Cramer's Mad Money on a regular basis, and I also appear on Bloomberg Television's Option Insight segment with Abigail Doolittle. For those that are our brokerage clients, we offer trading newsletters that include market commentary, opinions, trading recommendations. Trading Commodity Options with Integrity is actually my fifth title. And if you want to be technical, it's the seventh book I've written because I've written the Trader's First book on commodities a total of 3 times. There's 3 editions. The other 2 books were published by a different publisher and are no longer available. So if you go on Amazon and search for them, you might find them, but please don't pay those prices. It's ridiculous. If you want to learn about trading futures and options on futures, this trilogy is all you need, at least for now. Trader's First book on commodities is the first step. It's the ground level. Higher probability commodity trading goes into market analysis, putting strategies together, and then of course trading commodity options with creativity goes into the more complex side of option trading. Trading commodity options with creativity was a labor of love. Writing this book took longer and far more effort than I had anticipated allocating to the project. If it weren't for the fact that there's no crying in commodities, I might have shed a tear or two. It was a mammoth task that consumed my life at a time in which time itself was scarce. Details in chapter 20 in the end of the book. Nevertheless, in the end, I'm proud of the result, and I'm confident that the strategies, lessons, and examples in this book will help keep traders grounded while shortening their commodity options trading learning curve. I hope you enjoy it as much as I enjoyed finishing the project. Of course, as a broker and as an educator, it's my job to make sure you understand that there's a substantial risk of loss in trading futures and options. Trading is not suitable for everybody. Trading is not suitable for most people. This is a very risky and stressful endeavor. You should know that going in. Obviously, it isn't feasible for us to attempt to teach you how to trade options in a 10-minute video, so that's not what we're going to do here. But I do want to give you a glimpse into some of the topics that we discuss in my book, Trading Commodity Options with Creativity. The idea is we're trying to portray an unconventional but more logical approach to option trading. There are plenty of option books out there. I totally understand that, but none of them are like this, or at least not that I'm aware of. There are a few option books that focus specifically on commodities. In fact, I would say there's less than 5, and I wrote one of those in 2008. So there are very few books that focus only on options on futures, and that's what this book does. We're not talking about stock options, although we do talk a lot about options written against stock index futures. So it's similar. We're trading E-mini S&P, E-mini NASDAQ, those types of things, but we're not trading stock products. These are futures products, which are leveraged. So as you can imagine, the options are leveraged, the underlying asset, the futures are also leveraged. So we've got leverage on leverage, and that requires that we approach them a little differently than one might approach trading stocks or stock options. Also, most books are written from an academic point of view, not a trading point of view. This book was written to offer practical and actionable guidance for real-world trading scenarios, and I think that we did it successfully. Just keep in mind, stock options and commodity options are not the same thing. Calls and puts have the same general mechanics, but there's a lot of differences that you need to be aware of when you're switching from stock options to commodity options. One thing that I emphasize is options are building blocks to an endless number of strategies. So traders that are willing to be creative and think outside of the box can create any type of risk reward scenario that they want. There's basically two types of options, calls and puts, and two actions that can be taken on each of those. You can either buy a call or sell a call, buy a put or sell a put. Yet with various combinations of long and short calls and puts, it's possible to create a strategy that fits the need of any size or type of trader. So we're going to run through a real quick crash course in option mechanics. Obviously, we're not going to get into the nitty-gritty, but want to give you an idea of some of the things that we talk about in the book. Option value is derived by three factors: strike price, intrinsic value, and extrinsic value. Also, I'm well aware that this is a very boring and dry topic, which is why we keep it to a minimum in the book. Most of the book is focused on various strategies, real world trading examples, how things can go wrong, how things can go right, how you adjust your trade in those scenarios. But of course, we have to make sure everybody understands the basics before we get into the good stuff. The tricky part about option trading is it requires people to deal with fuzzy math, and they don't like that. And the fuzzy math comes with the fact that option value includes time value or extrinsic value, which are things that we cannot quantify or we can't predict. They're timed expiration, volatility, and demand. A lot of books will show you fancy graphs on what determines an option price, supply demand graphs, those types of things. But most people are visual learners, or at least I'm a visual learner. So it's a lot easier to look at a chart, a very simple chart such as this one. This is an example of one that we have in the book to help bring a concept across. This particular figure is showing us that close to the money strikes have more value than out of the money strikes. This is a simple concept. When you're reading a paragraph, it's hard to digest, but you can take one look at this figure and realize, duh. A February 58 call is going to be more expensive than a February 60 call. February 60 call is going to be more expensive than a 62 call. It's a very simple concept, but it's made even more simple by diagrams such as this. Intrinsic value also is a relatively simple concept that's hard to digest if you're reading a dry paragraph, but if you look at a figure, it's something that's very easy to determine. Most people, when they think of an option being in the money, they think of profit and loss, and that's not actually what it is. Being in the money means the option has intrinsic value, and that means that the futures price is beyond the strike price. So in this particular example, we're looking at a $4 call option in corn. If the futures price is below $4, it's out of the money. That option has no intrinsic value. If the option's above $4, suddenly it has intrinsic value. That intrinsic value equates to how far in the money the option is. So if corn's at 4.10, it has 10 cents of intrinsic value. If corn's at 4.20, it has 20 cents, and so on. So again, a diagram can make a very simple concept even more simple. Again, we just talked about option value involves intrinsic and extrinsic value. So if corn is trading at 4.10 and an option has an intrinsic value of 10 cents, that option's probably worth more than 10 cents because there's also timed expiration to account for. This is another example of a diagram that we use to simplify concepts that tend to be overcomplicated in other books. And it's just simply talking about implied volatility. Options that are at the money tend to have less implied volatility than deep out of the money options. This will mean more to you as you read the book and get a better base case for what option trading entails. The heart of this book is to drill the fact that most options lose money. Most options lose value. Options are priced to lose. Thus, you don't want to spend a lot of money buying calls and buying put. A better strategy is to use the market's money to purchase any options that you want to buy. And so there's quite a few examples of various strategies. There's ratio spreads, there's butterflies, call ladders. But the idea is you're selling one option or two options to pay for another. And there are possibilities to create option spreads in which it's free to the trader. Free is a tricky word because free doesn't mean that there's no margin charge or there's no risk. That's absolutely not what free means. In fact, nothing in life is free, especially not a free option trade. But what it does mean is you can get into the market for cheap, little out of pocket expense, and even maybe put yourself in a scenario where if you're wrong on the market direction, you might not lose much money, or maybe you won't lose any money at all. Maybe you'll just break even. That's the idea of trading free option spreads. So whether or not an option spread is free depends on how you, the trader, construct it. You are in control. That's the one thing that traders have a hard time with. They don't understand that they control their own fate and their own destiny. Sometimes that's hard to accept because if that fate turns out to be negative, it's hard to accept that we did that to ourselves, but that's exactly what happened. The market didn't do it to us, we did it to ourselves. Here's a couple of strategies that we talk about in the book that could possibly be free strategies. And this means that you're collecting enough premium on the short legs of the spreads to pay for the long legs. It could be a bull call spread with a naked leg, a bear put spread with a naked leg, a synthetic option situation where you're netting options against futures, covered calls and puts, or ratio spreads. Now, don't be intimidated by the names of these spreads. To be honest, this industry is creative. Some people have different names for the exact same strategy, and most strategies are basically the same general idea, just slightly modified, but then with a new fancy name. So don't let the names turn you off. This is actually a page from the book itself. Wanted to give you an idea of the format of it. And this doesn't even include the entire discussion. There's actually a continuation of this on the next page that shows the advantages and disadvantages of this particular strategy. But we go through this strategy as well as at least a dozen other. I guess I should have counted, but I would say there's probably maybe closer to 15 strategies. Man, should have counted. But there's a lot of strategies in the book. We give you why they're a good idea, why they're a bad idea, when they might work, when they might not work, what exactly it entails, what the risks would be, what the reward would be, so on and so forth. For every strategy that we discuss, and we provide advantages and disadvantages, we also provide an example, a trading example. These are based on actual market prices, so we're not just making things up here. I took real-time realistic prices. We also include a diagram or a chart of the futures price with the option payout on top of it, so you can easily understand where the profit zone is, where the risk zone is, where the break-even point is. And of course, we teach you how to calculate those items. So if you're interested in learning about commodity options, please visit tradingcommodityoptions.com, or of course the book is available at any major book outlet. Amazon is the cheapest. It's hard to beat Amazon, but you can get it anywhere. And if you're interested in autographed copies, we also have those available from us on our website, tradingcommodityoptions.com. I appreciate your support, whether you buy the book or not. Hopefully this video gave you some insight into whether or not this even sparks your interest. If you have any questions or if there's anything we can do for you, you can reach us at decarleytrading.com. And once again, here is my contact information. Also, if you decided that option trading is not for you, but you love dogs, follow me on Instagram and Twitter.